Enjoy it. All right, let me tweet this thing that we're going live.
Price winner, yeah, angel investor.
First in-person pod.
Yeah, you're lucky I'm here to set up. But all I can smell is your broccoli and chicken.
And kombucha.
Kombucha.
Free advertisement plug. How's the Iranian tea?
It's banging. The
Listen.
basil tea with cardamom in it.
We promo too much shit for free. My business mind is not happy about this recently, you know?
Well,
We big up too many things without any royalty checks, any board seats at allocation on the cap table. It's too much big ups, you know?
do you know why we don't do that?
Why?
Because every time we want to invest in something, we go around in circles.
In what sense?
In the sense that, not to get too deep, but we're very much about the rational side of things, and being as like thoughtful around what we invest in and how we invest. But fundamentally, I think sometimes this market is so gung-ho that you don't actually know what to invest in and where. And when the right opportunity presents itself, sometimes you can't actually see that opportunity. So if we're going to enter a deal with this Iranian tea brand,
Yeah, take them global via Shopify.
I'm sure they're more profitable than half the startups that exist in this market. So I don't think it's a bad idea.
True that. Facts on facts.
Facts.
Yeah, yesterday we were discussing, no names mentioned, but we were discussing investing pre-seed small check in a startup. And every time we have one of these discussions, it's me raising all these points, like pitching it to you. Me pitching it to you, even though obviously we both have the same sort of mindset, values around philosophies around investing, criteria, mostly anyway. But when we started Rational, you go back to the earlier episodes, you discussed portfolio allocation, I've discussed it.
Yeah.
It's very much, as you can see, it's the Munger philosophy of just life, deferred gratification, let it compound long-term, blah, 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 circle of competence, bunch of other shit. A company has moats. Clearly, it's obviously you're talking about profitable, really established companies. Clearly, what? Pre-seed, 40, like, what was the statistic you showed me the other day? 45% of the angel investments had no... What was it?
There's a Kaufman paper that talks about, I think they went out and they researched and they spoke to like loads of angels, like thousands of angels, right? And one of the key stats that came out of it was 45%. Let me get the exact number. 45% of early investments that these angels had invested in had no revenues when the initial investment was made. So they're obviously not investing from a financial lens. They're doing it based on either the product or the person.
They're doing a Quibi flex.
Yeah, they will.
Yeah, so basically we're discussing this and I was pitching it to you because obviously we do this to go back and forth to challenge each other's thoughts. And I said to you, I pitched it to you and you were like, yes, but... and then I said, right now, the way we'll pull up the Imad tweet, we'll throw it up on the screen.
Yeah.
But he said something around valuations. Do you have that tweet open?
Yeah, he said the Y Combinator one.
Yeah.
He said Y Combinator valuations are up from 1 year ago. The rest of the seed market will probably follow. This Y Combinator batch has pre-revenue in non-hot market around $15 million, which used to be $8 million. Second time founder in pre-traction at $20 million, which used to be $12 million. And 30K plus a month, $30,000 plus a month in revenue. Or hot market is $25 million plus, which used to be $15 million. But he says himself, his commentary is, I don't have a complete picture, but invested in circa 15 companies pre-demo day. Post-demo day will probably be higher. Another change this batch is that once the company hits their fundraising goal, they are pushing their valuations really high, either uncapped or 2 to 3x their start.
Well, I'm not gonna front like others. We like to keep it open book here, authentic, as they say, authenticity, content creation. But really and truly, specific knowledge, leverage. Funnily enough, we'll take a shot of I have it framed on the wall, people.
It's actually really nice, that. But, yeah.
It was a designer on Gumroad. $5.
Creator economy.
I'm funding everything.
Yeah, you're literally funding everything.
Your point around Imad's tweet is, and someone actually responded saying, "Oh, I was in YC batch 2018." Further down, I don't know if you can pull that up as well. And
yeah, Dave Rogan Moser, at Dave Rogan Moser, said we were at $175,000 monthly recurring revenue in YC winter 18 and raised at a $12 million cap. Probably could have pulled off 15 million cap, but highly doubt more. So just from winter 2018 to now, you're going from what he raised at a 12 million cap for to easily breaking the $25 million.
And Iman says maybe even, what did he say? Was it much higher valuation? His response to that tweet.
Yeah, if you were in the batch, it would be 30 million minimum, maybe 40.
Minimum, maybe 40. The reason Iman's opinion matters is because these are all YC startups. These are the creme de la creme of startup. He's not angel investing in any bogus thing that people just put in their bio, angel investor, and they're just putting in bogus companies.
What, through their crowdfunding campaigns? I invested 15 cents into this company. I'm now officially an investor. Who are you to say
There was
otherwise?
actually another funny tweet somewhere else. Someone said you should just invest by one share of publicly listed tech stocks, and then put the tombstones or whatever, put the logo of the company on your fund website and say we're investors in this company.
I rate it. It's marketing.
Anyway, back to Imad. So his opinion matters because he is in the heart of, literally, he's in the arena. Probably one of the very few people who can give an opinion on this. There is basically the discussion we started with. I would pitch things to you, and yesterday I was saying, this startup pre-seed, we should get in. And I was like, these days everything's getting marked up. Like you invest in something, a few months later, follow-on round, a few months after that, follow-on round. And I was like, yeah, look, if it doesn't work, this company will either get acquired or things might not go, whatever happens, even if things don't go well, there are going to be follow-on rounds and markups. And you were like, yeah, but this is not what we always preach. And I was like, yeah, I know it's not, but 90% of our portfolios, personal portfolios and investments, whatever, are very rational, strategic, call it Munger flex, call it Terry Smith flex, call it whatever flex. It's very logical, rational, well-researched, first principles, all of that good stuff.
Yep.
And I was like, this other 10%, which we always say, portfolio allocation, 10% should be dedicated towards speculation. You're throwing darts. It could be angel investing, it could be crypto, but it's money you're willing to lose when it leaves the account. And I was like, so when we're analyzing things in pre-seed, because me and you have to keep switching from our hats when we're looking at markets and then our hats when we're looking at pre-seed. And it's very tough to use the same brain to analyze both. It's just tough. Like you can try and make an active effort. And then, I said to you, so we have to use a different lens. We have to just look at it as this. But then you came back with another few points. And basically it's the struggle of, obviously you take, I would say, you take your hat off to, let's say, the hedge funds that have gone into tech like Tiger and Co2 and a bunch of others, because they're doing sort of almost all stages now. Tiger, there's even rumors they're going to go into even earlier stages than they already are.
Yeah, Andreessen released their, $800 million fund for pre-seed investment.
Exactly. But then you go back to the point of incentives and Nassim Taleb, the goat skin in the game. Most of these funds are investing not their own money, as Chamath says as well. It's LPs funding this, further funding. So if you're the people I respect most, as Antonio Garcia Martinez says in Chaos Monkeys, shout out for the 50 million time reference. He says, there's angel investors, people who pretend they're angel investors, and then there's real angel investors, which is, he didn't say this, but in my terms, old white money in the valley, which is a white hair slicked back in his 60s, OG in the valley, and he was throwing a 4 million check of his own money, real skin in the game. And he did mention sort of having skin in the game or whatever in his book. So that's the people that, but like even Tiger and Co too, it's just because they have so much fucking funding. I think the real people to model pre-seed off is the very few OG angels in the valley, because they have the most skin in the game. It's the most respect you can have for anyone investing, I think, is that the most high risk, yes, high reward as well. But conclusion, what I was trying to get at yesterday is I was throwing all these things at you. You're like, but I don't know what you think. Where does it end?
The thing is, someone came to us someone didn't come to us. You found an opportunity to invest in a new startup, right? Software startup, B2B, B2C, whatever. And, you were impressed by the team and you're impressed by, a lot of the product. You use the product. I use the product. And you came to me and you said, we should invest in this company because of really good people. The potential for markup is huge. It's a software business. So therefore, it can exponentially grow really quickly. So why not give it a shot? And then the challenge was a couple of things. The first is it's not really either of our domain expertise. I'm more on the energy side. You're maybe more on the fintech side.
Fintech SaaS.
Exactly, fintech SaaS
Your
side.
energy and EV.
So it didn't really I couldn't tell you if the product's cool when I used it, but I couldn't tell you if the target market would use that product, and I don't know how much they'd value it. So immediately my question from a diligence perspective was like, actually, who do we need to talk to that would be able to verify whether this is a good product or not? But that's, I guess, the rational, quote unquote, approach to thinking about a startup investment, particularly at the angel round. A lot of the time, and I think the Kaufman paper that we referenced earlier talks to this, in that realistically, a lot of the time you're not investing in a company that is already, doing anything financially. You're investing in people and you're investing in a product. If you believe in those people and you believe in that product, go for it. The challenge with that is, a lot of the time you're going to get a question around opportunity cost of that capital. What else could we do with that money that would be preferential? And I think there was a guy called Ethan Mollick who tweeted about this. He said, venture capitalists are specialists. This paper shows, he quotes a paper, this paper shows that VC performance is much better in the sub-industry they focus on, especially for very specific focuses, i.e. computer graphics rather than all hardware. Further, they underperform more the further outside their focus they go. What he's getting at is specialization is key to getting outsized returns in venture, and I assume the same thing applies in angel investing, which then goes back to a point of, we don't really know much about this market. Should we really be investing? Now, I genuinely think this startup will make like a large markup. Are we willing to take that risk when we could take our cash and put it into a startup that we can actually diligence properly and understand better? Maybe, maybe not. That's something for us to discuss. But I think it's a good thought process to go through.
Yeah, it's funny because I heard Mark Andreessen on a podcast literally explain this as well. And he said some of the investments I've made, which I thought were going to be home runs, went to shit. Some of the investments which I was having second thoughts of why we're doing this turned out to be some of the best investments, some of them anyway. There's no way of knowing in pre-seed, and you said like you're betting on the team and the product. I'd say literally mostly even just team, because
small team.
At that stage products pivot so much in the following few months or whatever, sometimes years, that you're really just betting on the team and their ability to execute. So I do a lot of, and we always talk about this first principles approach, which is an overused term at this stage, but of due diligence on the people.
Yeah.
Traditionally, due diligence would be people would make a few phone calls to your previous employers, previous business partners, previous investors, get to know, get a lot of reference. I think one example, more extreme end, Frank Slootman talks about this in his book, Tape Sucks, which was published 10 years ago, legendary book about the earlier business they had. And he mentioned one, I read this ages ago, but he mentioned one biz dev guy trying to get hired to head up biz dev in another company or something. Okay. And that company did over 70 references, if I recall. So they called up 70 different people that he had interacted with in a business sense. So they did a full due diligence on how is this guy as a person. Yeah. And I think it was like 76 or 80, I can't remember the exact figure, all came back perfect but one. And that one sort of caused some trouble or whatever, which sort of threw a spanner in the works. They had to negotiate a few things. But my point is, like, yes, you can do all of that, but I'd say you take even a step further, which is, I think I've mentioned this before. When I want to analyze someone, or even before I meet them, you're gonna get sick of this. AGM says this is why when I read AGM, I'm like, yes, this guy's in my brain. It's literally what I've been thinking. Before I meet someone, AGM does the same thing. He says in Chaos Monkeys, I demolish Google and socials and just doing DD on their background, who they are as a person. I've always been like that. Before I meet someone, before I take a meeting, right, let's do the rounds. Let's go on Facebook, let's go on Twitter, let's go on LinkedIn, let's Google them, let's go to the 10th page of Google, let's do advanced search on Google, let's check all the socials. For example, on their let's say for example on their Twitter, Instagram, who are they following? What type of people do they have photos with? Who are they tagged with? How long have they been in this industry? And then further cues like when you meet them. And I'm very pro remote work, but important meetings like when you're allocating checks, I still think yes, take the meeting by Zoom, but if you're almost certain you're going to invest, take the final meeting in person because you can pick up so many cues in person regarding body language, tonality. Are they bullshitting you? Sort of eye movements. A funny thing is when people lie, not everyone, but most people, and there are the cues you can read about on Google and in books, but when some people lie, they blink a few times more or they look in a different... It's just subtle cues that once you read about and learn and you start looking for more, you see it. Just really seeing, is the person authentic, the integrity they have, the values, does it align with yours? So that's really it in a nutshell. Pre-seed, you were literally just betting on a person, and shout out Naval, as he says, beyond the long-term gain, learn to build, learn to sell, specific knowledge, accountability, leverage, but then it goes to fundamental skills, experience. Okay, you don't need experience at pre-seed necessarily. Judgment, ethical creation, collaboration, compounding, and iterated gains, which means pivoting. So I think the ethics comes beyond everything for me, because as he mentioned, like his 4-hour pod, someone like Buffett, that's maximum accountability. Like he literally gets to bail out banks because his name speaks for his track record. The ethics have always been at the forefront of everything he does. So,
and as we said earlier, it's different, right? So what these two guys behind me, their approach was very much long-termist and whatever. They're obviously betting in public markets as well, and it's not betting for them because they're doing ridiculously large amounts of diligence around the financial aspects of a company, and the moat element you mentioned earlier. But the point is, Angel is different because, again, you're betting on the individual, which of course requires all this psychological element you just spoke about. But I want to bring up a stat, which is in that Kaufman paper we mentioned, there is a chart on it which shows the impact of time in due diligence. So how much time you spend diligencing a company as an angel, what is the impact of that in terms of the return that you get on that initial investment? The overall multiple for low diligence, right? So a short period of diligence. Now, bear in mind their median diligence time is 20 hours, which is actually really low. 20 hours is really, really low. Really? And that's the median. So low diligence is less than 20 hours. It's a 1.1x return. So just to contextualize that, as an angel, if you're betting in loads of companies and you're spending less than 20 hours doing due diligence on that company that you're going to invest in,
which is most these days,
you're going to make a 1.1 times return on your money. And usually that happens within 3.5 years. Now, if you do high diligence, right? And high diligence is more than 20 hours, which by the way is nothing.
Yep.
You get a 5.9x return. You get 6x return. So it's between 1 and 6, the difference. And the time it takes to maturation, the time it takes to actually reach that level is 4.1 years. So if you wait 6 months longer and you make that much money. Now, this isn't obviously a hard and fast rule. And obviously Kaufman's talked to angels that are really well established and really good and really, they're really essentially powerful voices in the market, hence why he's going to talk to them. And what's quite telling about that element is that the overall multiple by angel investor that he spoke to was greater than 1x for 61% of the people that he spoke to, right? But anyway, the point I'm trying to raise is a lot of the time when you compare people like Buffett and Munger to people that angel invest, it's like comparing apples and oranges. But the one thread that sits between the two of them is team and the psychology you use to measure that team's ability and background and drive and all of that good stuff. I think that we still haven't made a decision on that investment opportunity that we have. I guess we made some sort of decision, but it's pending some things we need to talk about. But the point is, angel investing is more an art and it's more a game than it is a science. And I think if you can follow some of the steps that make it somewhat of a pseudoscience, you could call it, then yes, you're going in the right direction. But a lot of the time, it's going to end up being luck, and it's going to end up being how you perceive the person.
Loads of facts there with 2 X's.
Facts.
Yes, exactly that. Whether it's an art or a science, it's like when, you know, young kids reach out to us through Minority in Tech community we run. They're like, I want to become a VC, and they're trying to do all this technical shit. And I'm like, it's a game of sales and marketing. Similarly, exactly as you said, it's more art than science. Then again, and you look at like the diligence here. You've meant. I mean, it says here the impact. We'll throw up all of these on the screen, but the impact of time and due diligence. No VC. This is a key point. The reason, Will Brewery, which we had on a recent episode, is a SpaceX OG who's CEO and co-founder of Vada Space with Delian and Daniel Marshall. Those guys, Will Brewery has a small fund on the side, which is called Also Capital. He literally said to us, is like, for a 40K check we throw in a startup, like a tiny check, we're outsized by everyone else, we'd probably be asking the most questions, and you feel like you're being a pain.
Yeah.
But I guess that's what we're like as well, in the sense that, and we hope to be more of, because it's evident in the statistics and data in this Kaufman report, which is great, what comes of it. And the key point, which we always go back to in the first ever article I published on our website, Tech Marketer Irrational, What to Avoid, quoting many of the GOATs, it really came down to there's a misalignment of incentives. It's all fucked up. There is no skin in the game. The problem is skin in the game. There's one of the best books ever written by Taleb, in my view, Skin in the Game. And the problem is when we hear stories every day, all the time, whatever, you just hear of people throwing checks within 10, 15 minutes, 20 minutes, half an hour. Sometimes, yeah, because they really understand, going back to the specialist versus generalist, sometimes they just know they're a specialist in that field. They're like, this is it.
Yeah.
And they believe in the team and many other factors. But there are exceptions to every rule. In most cases, however, it's literally just throwing money out the door because they've raised a huge fund and they don't have any it's not their own money. There's no skin in the game. And that's what it really comes down to. Whereas people in this report, and this is a fantastic fucking report because it says up here, median age of the angel investors are 57. And we're like, what? And then you look further into it, you're like, oh, okay, this report is actually of the real angel investors, those that, as I said earlier, AGM Antonio was talking about, which is old white money in the valley who have maximum skin in the game, their own funds. They'll post up, in some cases, millions in a company on their own with their own funds, no LPs at all. Similar to an investor Antonio had in his company back in the day when he was going through YC, post YC. So it really comes down to incentives. It really comes down to skin in the game, and there's not really more to. So we can sit here and complicate shit like most people try and sound like geniuses. I mean, we're not geniuses, but there's no rocket science to this.
The interesting thing is, literally on that point,
the rocket scientist Will Brewery himself.
Yeah, exactly. That's literally what I was going to say. What's interesting is we literally talk to the rocket scientist, and even he doesn't treat it like rocket science. Anyway, the point is, literally on the profiles of the angels you just talked about, the median, 57 years of age. Okay, great. What else makes them interesting? They've all spent on average, they've spent 15 years as an entrepreneur before investing. So they know what they're looking for, specialist versus generalist.
Yep.
Number of investments, 10 on average, which is actually not that much, but years of investing is 9. They've spent 9 years investing. So these guys are the creme de la creme, but they've spent like a decade investing. This isn't a short-term thing, which goes back to the point around us thinking about our investments is, we got a long way to go, man. We've got a long way to go, and we're going to do loads more investments. But we have the opportunity right now to jump into a lot of startups because it's gung-ho at the minute.
To strip it all back, how we started this conversation, right now there is a lot of FOMO and greed as ever, but even it's record FOMO and greed that I've ever seen. And everyone and their auntie wants to be a fucking angel investor. We are not angel investors in the sense that it's not our full-time job. We don't claim to be experts, because how I see it, there are two ways of doing it. There's this high due diligence way, which is the correct way with your own money, or there's also putting in your own money, tiny amount, but you still do due diligence, which is what we're doing, which I believe Shervin Pishavar posted a tweet ages ago on this. He said, when I started up back in the day, I post like a few grand checks in just friends' companies or whatever when I got started. Some of these took off, the markups and returns paid off for him to invest in more startups. But the fact is, it was his own money.
Yeah.
And he was in the arena, in sort of mingling, creating contacts network, putting money in. That pot grew until he started the mega monster that was his latest VC fund. So that's the other good way I see of doing it. But people who are just throwing checks, either not their own money, no skin in the game, really fast, or people who are throwing their own money, small checks, but no diligence. Good luck to you. It probably may work out, but I don't see that. It's going back to your principles as a person, the values you have, which you remind me of yesterday, because I always talk about, our values and all this stuff. You're like, yeah, but this doesn't align with the values. And I said, yes, but 90% of our portfolios are heavy diligence, public equity markets, tech stocks, whatever. But the other 10% is speculation. But then as you reminded, yes, but even the speculation, there's ways of doing it. There's a lot of, you do more diligence, make sure you are, and you can go more into, and I've rambled on a lot, but you can go more into the specialist versus generalist debate. There are fucking heaps of books written on this. Robert Greene Mastery.
10,000 hour rule.
10,000 hour, or even Cal Newport talks about in his sort of career advice, be so good they can't ignore you. He's like, get really fucking good at one thing.
And it doesn't matter what it is, just figure, and it's the specific knowledge point around Naval as well, right?
Yeah, Naval specific knowledge, like it all comes back to the same thing, and all the goats are saying the same thing.
Yeah. What's interesting though is on that point that you raised, like these guys are cutting big checks. The data actually tells us the dollars per deal invested is the median was 50K. So these guys were like, that is way, like that is not small for an angel check. The dollar per deal invested, the mean number, which tells you that this is a power law game and there's more people investing at the bigger end, was 200K, 191K. So like, and the other part is the percentage of the wealth that they put into angel investing is literally what we say all the time around portfolio allocation is 10%. The goats, the best angels, the angels that do angel investing as their full-time job are putting 10% of their wealth into angel investments. Like this is, like if they're doing that, what the hell are other people doing? Putting hundreds and hundreds of thousands. Like
Sahil had a very good tweet, because there is a bubble, I think, because anyone and everyone is trying to become an angel investor. But Sahil had a great tweet today, which says something along the lines of only put in what you're willing to lose.
Yeah.
Because clearly, or I've seen anyway, you see a lot of people who just put in more than, whether it's angel investing, whether it's NFTs, crypto, people put in more than they're willing to lose in speculation.
Yeah.
At the end of the day, it's gambling. But if 90% of your portfolio is well just research invested, whatever, and the other 10% is speculation, that's what we always said. I feel like a broken record, like it gets tiring. But like, just to wrap up, I don't know what your thoughts are on just portfolio allocation in general, and maybe want to touch on investment inertia as well.
Well, so we'll get to investment inertia in a sec. The short answer to what we'll get to there is just bloody invest, man. Just put money aside for investing. But that's a separate point. We'll come to that in a second. I did a video on this on YouTube I think it was back in March or something.
Links here if you're watching on YouTube.
And in the show notes. And then there is I put a pie chart up next to my beautiful face, which shows the amount of where my money basically goes, right? Really simply, I put 20% of my money in cash, because you always need cash and you never know what's going to happen. 20% of my money is just in ETFs, simple exchange traded funds in the public markets. 30% go into big companies, blue chips. Now that's mostly tech stocks, but blue chip stocks. 20% goes into high growth stocks, so like your Teslas and whatnot. Although I would argue that's becoming more blue chip now. And then 10% is speculation. In March, I posted this, and data from Kaufman backs this up, is that put 10% of your money, if speculation is angel investing, what else is it? It's Bitcoin, it's, I don't know, Ethereum, it's NFTs, although I'm not involved. Put that meme on again.
It's a separate episode.
But yeah, look, that's the approach both of us take. I think that's pretty clear that we both do pretty similar things.
The other thing is, if you want to get into angel investing, well, it'll be very tough, but you have to build the contacts, relationships.
Yeah.
But if you can get into a fund who's, for example, Weekend Fund, Ryan Hoover, literally the founder of Product Hunt, the goatest of goat pipelines of pre-seed and early stage.
That and AngelList.
Angel is just biggest hat tip in the world. It's
you know what we should do? Next time we do an episode, we should have a cutout of Naval here.
We should be sponsored.
We should be sponsored.
A way to de-risk is a few ways. Because if you're putting money into one company, more likely than not, that's not going to work out. We know the failure rate of startups being 90% or whatever. So if you can put money into something like a rolling fund, okay, before we get to rolling fund, if you can put money in something like Ryan Hoover's weekend fund, where he raised, I don't know, his last fund from 1,000 LPs.
If you can, by the way, because it's so hard to get in.
If you can, but if you're doing the right things, let's say, I don't know, putting out good tweets, putting out good blogs, thought pieces, adding value for people, networking, just doing all the shit, you're hustling basically. And you get into, let's say, this tech circle, and you can get a small allocation, great, because Ryan Hoover, firstly, is a fucking expert. Secondly, hot pipeline. Thirdly, he'll distribute that money across several startups, so it's somewhat diversified. Or just other people like Ryan doing similar things, or rolling funds. Because rolling fund, plug here, as I made a video on it, you're investing in a basket of startups rather than one single startup. So investing in a basket is further, and
it goes against what that guy says, though.
yeah,
what,
it goes against what it says. But and you have so much like fucking back and forth on Twitter, tech bros taking the piss out of Munger and Buffett's mentality and philosophies, and then these guys just absolutely shit on this kind of philosophy and mentality. But Munger always, says, I take my hat off to Sequoia. It's like tremendous what they've done. I would never be able to do that, is what he said.
Yeah, he did.
But then people just have like no fucking, firstly, no critical thinking. Secondly, no balance. It's like, yes, what has worked for a specific person at a specific time with many specifics is not going to work for you. Just fucking read, learn a shit ton from many different points of view, and then come up with your own Naval judgments.
I'm gonna set you a task. Go 5 minutes without mentioning his name. Go on.
Take a shot every time you make Naval. New game. But literally, judgment being one of the most important points, because people take the piss out of there's these normal distribution charts, which is like these people in the middle with the brain exploding, stressed out.
Meme.
See the meme, if we can find it, we'll throw it up. Which is the people in the middle, are like those who are like mental model, decision making, judgment, and like, yeah. But like at the same time, these guys have been forethought. They've literally been like the pioneers of just teaching people about how to think better, how to use whatever. I mean, it's an overused term now, but mental models, whatever the fuck. But look how it's worked out for them.
Yeah.
They literally, these guys don't even fucking work out. And they're, touch wood, happy birthday to Buffett today. Actually.
It is actually his birthday, yeah.
The reason these guys have lived so long is because they're so fucking low stress.
Yeah. The stress element is
because they've done deferred gratification. Everything else they've done right. Everything else they've lived by their values and principles.
and they do it to such an extreme that how old is
Munger 97.
now how old's Warren
91 today.
91.
Yeah.
91, and okay, when he speaks he sounds like quite slow and methodical, but his
sharper
brain
than most tech bros, or all tech bros.
His brain is sharp as a tack. But your point was, if you're going to get started in angel investing, the way to do it today might differ to how they do it, although the way they do it is still fine. But they don't do angel investing, they're public markets. If you want to invest public style, go follow them.
And even then, value investing is dead.
Yeah.
They've been moving into tech themselves.
Exactly.
They've been doing other things.
But the same principles apply to tech.
Yeah.
I'm
not saying like literally exactly photocopy their philosophy or way of doing things.
100%.
We're saying just the macro philosophies of how to invest, which is very similar to Morgan Housel, The Psychology of Money, for instance.
Take a shot, because he should have been on the shot list.
So many plugs.
Yeah, but anyway, talk to me about the inertia of investing, because it goes back to these guys. It goes back to Buffett and Munger.
Let me get the book. I can't reach. I can't even. Okay, the goat, Jason Zweig, Jason Zweig, who wrote The Intelligent Investor.
Yeah.
Writes a lot for the Wall Street Journal, and that's literally the only reason I'm subscribed to the Wall Street Journal. I'm not impressed really by what they publish.
I don't like Wall Street. I mean, it's good and it gives you good takes, but yeah.
It's kind of like I've subscribed to Jason's Substack. Think of it that way. So anyway, his latest article we'll link it. It's called The Lazy Investor's Guide to Getting Stuff Done. Your investment inertia could be costing you thousands of dollars. Here's how to break out of it. And what he's talking about in a nutshell is when a lot of people, obviously, especially people in their 40s and 50s, have, let's say, invested in some index funds, and that's been sitting there 10, 15, 20 years. And then you're saying, okay, but it's not performing very well, and there's much better performing things you can put your money in, not gambling, but actually even other index funds, you know?
Yeah.
But the inertia would cost you many hundreds, probably hundreds of thousands of dollars or whatever if you just moved it to a fund with higher returns. And every time you think about switching, it's like anything else. And it's really interesting. You strip it back to first principles, the human brain. It's like anything else in life. You like, I put it off, that kind of admin. Let me go and clean the whole house first. Let me go and...
I don't know what you get up to in your spare time.
I don't do that. But anyway, I'm anti-manual labor. But hey.
I know, I set everything up.
Point is, like, opportunity cost. Okay, what could you be putting your money in? And then before I touch on that, Martin McHugh, who had the best comment on this as a subscriber, said, "I'm slowly getting comfortable with the conclusion that the injection of trillions of dollars into the economy is going to significantly and irretrievably cheapen the value of our currency. That means it should take more dollars to buy stocks in the future, even if the intrinsic value of a company does not change. That also means the market, despite its highs, should tend to go up even more in the future, even if it also means that you'll also need more of those cheapened dollars to buy everything else in the economy too. And in turn, what that really means is that it is still probably a mistake to let dollars sit uninvested right now." This article by Jason reinforced that view for me. And someone says, bingo, sitting on cash is a speculative position on inflation and equity or bond returns. There is no such thing as not taking a position. Anyway, point of the story is we know that right now, especially what we've seen in the past year since pandemic, it's idiotic to leave cash uninvested. Of course, yeah, you have a DNT, do not touch cash fund on the side, which is whatever, a few months, 1 year, 2 years runway based on personal preference. But beyond that, cash should not be sitting uninvested. And investment inertia, I suppose if you strip it back to first principles, as I said, there's been so many books written on human behavior and psychology and just how humans, let's say, the same rationale, the same limbic systems or whatever of the brain that says, I'm going to put this off, I'm going to go and do this or do that, is the same part of the brain that a tech bro would probably say, yeah, angel invest, I'm going to throw lots of tickets without any DD at all of these startups so I can, because no one wants to do the work, basically. No one wants to do that. And when you strip it back, humans are there, and we always say first principle, like first take 50 shots right now, take a gallon of vodka. But when you say first principles, this is really it. You strip it back. It's always, as Munger says, you study economics, psychology, human behavior, you study all the basic principles, and you're like, yeah, it always, like, history, it leads back to the same thing. Like,
100%.
Human behavior is human behavior, and it goes back to our ancestors, cavemen, and all that shit, and our, just our genetics, really, and how we've always been. And it's really just having the self-awareness of, I've mentioned this once before, you pissed yourself, but having the quote unquote, very woo woo, but it's the third eye, the meditative eye of observing oneself and being like, that behavior is bullshit right now, and I'm putting this off. Maybe I should get the fuck up. I should stop being a bitch. And it's not that easy. Maybe go listen to some David Goggins and he'll tell you you're a piece of shit. But
while he completes his 18th marathon of the day, so I think Zweig's article was really good because it picks up on the human element of inertia around investing. So, like, get up off your bum and go and actually invest that money. And if you think it's not returning what you want it to return, to the extent that it's not impacting the compounding element of that fund, go and move it elsewhere. Take some money and put it elsewhere. Think about the portfolio allocation we spoke about in terms of percentage allocation to things like speculation. Think about where else that money could go. Fine, but diligence it right and don't be lazy about it. I think that's quite important. The other point around the comment that was made on the article, The McHugh comment. McHugh. His point is fundamentally around inflation in the sense that the inertia will cost you more than making the wrong decision will. I.e., put your money in a fund, and if the fund doesn't return the amount you need it to, okay, fine, you're still making a small return. Don't put your money in a fund, and what's going to end up happening is inflation is going to eat the crap out of the value of your money. And the really interesting thing is, literally just before we started recording, Germany has released its inflation rate, and it looks like German inflation surges to 3.4%, which is the highest level in 13 years. This is a predecessor to what's going to happen. Rates are going to have to come up at some point. So leaving your money unattended and uninvested is probably literally the worst thing you could do.
All of that well and good, but how can one do all of this and be self-aware and everything me and you have just said? How can you do that when you're in this tech bubble, you go on Twitter and
get out of the bubble
and you spend, but then if you're out the bubble, you don't have a pipeline of pre-seed to invest. You know what I mean? You go on Twitter and no matter how hard you try, the FOMO and greed will kick in because it's just, and you're not aware because everyone's posting all this highlight reel bullshit on Twitter of I've invested in this, I've raised 800 million, I've done this, I've done this, and you're sitting there getting FOMO. You're like, these people know better than me. Why are they doing all of this? And why, like, raising ridiculous, whatever. Twitter is dangerous, but at the same time, it's one of the best tools. I have a love-hate relationship with Twitter.
Yeah, no, you're on it for 18 hours of the day for a week, and then you're off it for 7 weeks straight.
And I'm off like, yeah, that's what I do.
Twitter is a dangerous place if you're not regulating your usage.
Yeah.
What I would say is also Twitter's an echo chamber, hence why
I'm going to pull up this tweet right now by Harry Hurst recently. He said, a reminder that Twitter isn't real life. The opinions on here are often the opinions of the minority in an echo chamber. If you want to be happy and successful, go outside, talk to people, and solve real problems together.
That's a great tweet. I hadn't seen that tweet. That's a great tweet. But his point is valid in the sense that just because your Twitter will give you access to a lot of funds, will give you access to a lot of people, and it will help you build your relationships with those people pretty quickly and pretty strongly, and you'll build a fan base really quickly on Twitter. It's great. But look, Twitter is the place where people, and Instagram is the same, all socials are the same. People only see the W's. People only see the wins.
Instagram is below IQ, but carry on.
But no, but this is still the same concept.
Yeah,
right?
yeah.
It's that on Instagram, you see a guy that's super shredded and he's been working out for, 10 years.
More dates.
More plates, more dates is YouTube. But like the guy is like, huge and he's ripped. And what you don't see is the 10 years of juicing and the 10 years of hard work that got him there, right? So like Twitter is exactly the same in this environment because it's, I invested 6 months ago at the pre-seed round of this, tech company. Mm-hmm. It's now worth X amount. Well, number one, they don't have access to that cash because they're not going to pull their position out. Yep. Look at Calacanis with his Uber position. Like he still hasn't cashed out half of that. And like two, you are seeing, like I said, you're only seeing the W. You're not seeing what this person has had to go through to get to that point. So basically my point is take everything with a pinch of salt, man, especially on Twitter.
And look, there are shit ton. Most of the businesses that are successful, you don't see the founders on Twitter.
Yeah, 100%.
But the problem is, I'm catching myself doing this. I get on there, I'm like, this is the fucking best. It's like you find your tribe. All the nerds assemble together in one place.
You basically go on Antonio Garcia Martinez's page and you're literally...
That was me when I read the book. Like phenomenal. Anyway,
should we wrap it up?
We should, but just final thing to add on that point is, yeah, it's tough. Like no one in the world, no one I know in tech has said, I use Twitter in moderation. At the same time, someone like Harry Hurst, who said this, which I agree with, also tweeted something last year posted his analytics from Twitter saying, can you believe this platform is free so much? Oh, so many opportunities come for me. Like, I know of other founders who have raised multi-millions just through Twitter DMs. So yes, but you need to know how to use it. And it's I don't know. There's no right answer.
I think the topic. What we should call this podcast is moderation. The topic of this conversation has been all about finding the moderate part of the argument. which goes against some of our principles, which are some of your principles around having 2 feet in the water. Don't half-assed go everything full as to the extent that you can.
Yes,
but with moderation.
Agreed. But that doesn't the go both feet in rather than the one in one out doesn't really apply with things that can become a time suck like Twitter.
Correct.
Or things that have a higher downside than upside. I would say, for example. You're talking about, let's say, more angel investing and speculative investing versus market. That's not going to end well. Clearly, it's not going to end well. You just do the numbers.
Well, let me stop you there. I saw on Twitter a guy that invested in NFT for $1,000 and now it's worth £18 billion.
You get my point. And really, bottom line, we don't have all the answers, as most channels would probably sit there and pretend they do. We don't have all the answers, despite, as I've said before, we've spent more time in finance than most of these finance pods and whatever. Yet we're the ones who are like, we don't have the answers because, one, no one can predict the market. Two, just use some fucking common sense. Like, I've improved on my Twitter usage because, as you said, I'll get on it aggressively for 1 week, I'll demolish it, and then I'll go off it for 7 or 8 weeks completely without even having access to my own password. Like, that aggressive. That's still not good. It's better than before, still not good.
By the way, that's a true story because sometimes you message me saying, can you like this? I can't enter Twitter right now.
So that's how I'm still trying to improve on it. But end of the day, beside all of this, from just zooming out macro, the way to end this, I would say, is it all comes down to improving your judgment and thinking, which is what people take the piss out of with this meme saying, oh, mental models, critical thinking, judgment, decision making. But I think what better than having those tools at your disposal? Look at Nassim Taleb, one of the best thinkers of our time. I think the best thinker of our time. I'm biased, but
you are.
I thought
you were going to say AGM, but okay.
In that sense, I'm not very rational. I guess some would say, but I think it's very rational because he is one of the most rational people.
Yeah, he's ultra rational.
He's ultra rational, and if you, what a great way to end. Fucking on brand, not even intentional. Let's get some merch, baby.
All right.
Okay. Merch website coming soon. More fingers and more pies.
Diversification.
Diversification of the diversification.
All right.
Yeah. Stay rational.
Check out our website for the latest essays.
Rationalvc.com. Not going to plug it anymore. Just go and don't subscribe. Actually, you don't subscribe.
No, please do.
It's too good. You shouldn't even. You should be paying us. It's free. Why is it still free?
Free material. I don't know, man. I put a lot of my time and effort, and he puts a lot of his time and effort into writing stuff. So
let's do
enjoy
like
it while you can.
Let's be like those Twitter accounts that are like 10 PDFs left, 4 PDFs going soon, gone. It's free now. If you don't sign up, you're gonna have to pay in 2 days. That's my fake pitch.
All right.
All right. Nice. I like doing this in person.
It's much better.
Time to hit a post-workout meal. 4,000 calories.
You're going to stink up this room.
Shout out to Mark Ripperto.
Peace.
All right. Catch you on the next one.